Hello, my name is Carl Johnson. I'm a certified financial planner with Arrow Advisors right here in Madison, Wisconsin. Today's topic of discussion is going to be disability insurance. I have a few topics that I'm discussing in this seminar series, but today's is going to be disability insurance. If you have any questions or want to contact me for any reason, my phone number and email are on this slide. Here's my disclosure. Now let's get started. Again, today's topic is disability insurance. So I want to just start with just a summary of what is disability insurance. So disability insurance pays you an income benefit when you're unable to go to work because of a sickness or injury. For today's purposes, I'm going to mainly focus on long-term disability insurance. A long-term disability is a disability that lasts 90 days or longer. Short-term disability tends to last less than 90 days. We're going to cover when to get disability insurance, how much to get, from where. We're going to cover different definitions of the policy, features, riders, companies, exclusions, and what disability insurance generally costs. What causes most disabilities? When I ask this question to somebody in person, I mostly get car accidents as a response. Accidents cause less than 10% of all the disability claims out there. Illnesses cause far more. So whether it's cancer, connective issues, mental psychiatric disorders, cardiovascular, when you're thinking of a disability insurance, I just wanted to put in perspective, it's almost always an illness, and most of those illnesses are out of our control. Now, when to get disability insurance? So your ability to earn an income is by far your most important asset at this stage of your life. So the scenario that I like to use is if you had a machine in your basement that printed money, and every day you went down in your basement and it was printing $100 bills, that'd be a pretty cool machine to have in your basement. But that machine, when you looked at it, had a lot of intricate parts, had little gears and little levers and little switches that were all used to print that money. When would you insure that machine? That machine is obviously a metaphor for you. You get up every day, go to work, earn income. Most of you probably want to earn more income in the future than you are today, but you're still a machine that produces income, and there's a lot of intricate parts on you that can go wrong, and if that goes wrong, it would probably prevent you from earning the income potential that you have. So my suggestion always is to get disability insurance now. So if you do not have an individual disability insurance policy as a resident or fellow, I would strongly suggest that you look into getting one sooner than later. Here's an example of the importance of disability insurance. Let's say you're out interviewing for jobs and you found a job that you like and you're going to accept. You just need to negotiate the contract terms. The future employer comes back and gives you two contract offers. Contract number one is they'll tell you they'll pay you a $300,000 salary as long as you come in and work and do your job. If something were to happen to you and you got sick or injured and could no longer do your job, you're on your own and they would pay you zero. Or you can accept contract number two. Contract number two, they're going to pay you slightly less money, $295,000 a year salary. And if something were to happen to you where you got sick or hurt and couldn't do your work, they would continue to pay you a $250,000 salary until you could recover and come back to work. This example of contract one would be full salary, no disability. Contract two would be taking $5,000 of income and buying a disability policy, which would in essence insure a $250,000 income. If you're leaning towards contract number two, that's the disability insurance. Now, there's a lot of different options on a disability policy when you buy it. So, when it comes to options of coverage, Social Security is an option. It might not be a good option, but it is an option. Social Security has a limited benefit and it has a very weak definition of disability. Very few physician clients that I have want to rely on Social Security as a disability benefit. The other benefit that you might have is work. So your group benefit might provide coverage. With a benefit, you have no control over the coverage in terms of the quality of the coverage or the features of the coverage or how much monthly benefit the coverage is. And for most physicians, the monthly benefit is rarely enough to fully insure your income. I've also seen it where people go to work and they have very good, robust group plans, and they're working for a large hospital, and then the hospital, as a cost saving measure, changes the group plan to be not it, and you have no control over that. The third option is to acquire an individual disability insurance policy. With an individual disability insurance policy, you control the definitions, the features, the riders, and the amount of benefit. The individual policy can go with you job to job, state to state, and can never be changed by the insurance company. And if you put the increased rider on the policy, as your income goes up, you can increase policy coverage without ever answering another health question. All fellows and most residents can get $5,000 a month of benefit regardless of your current fellowship income or your current group benefits. The insurance companies do this because they know you're not going to be a fellow for your entire life, and eventually you'll be qualifying for this coverage. The other you can qualify for how much benefit you can get is all first-year physicians, and a first-year physician is somebody that's within 6 months of going into practice or has started practice within the last 12 months. So you actually have 18 months that you'd qualify as a first-year physician. A first-year physician can get $6,000, $6,500, or $7,500 a month of benefits, regardless of whatever income or group benefits that person has. Whether it's $6,000, $6,500, or $7,500 a month depends upon the specialty of the physician. The higher paying specialties tend to have the higher monthly benefit caps. The third option of how much disability insurance somebody can qualify for is just based upon income. So if somebody is working and has a $400,000 income or a $400,000 contract with $10,000 a month of group benefits provided by their employer, that individual can still get $13,830 a month of individual coverage if they wanted to max their coverage out. Now let's go through some definitions that you should be aware of when you're evaluating contract options. The first and most important part of a disability contract is, what does the company consider a disability? There's two important parts that you want to see to this: own occupation or own specialty definition of disability. Most physicians want to see either own occupation or own specialty in their definition. When you want that definition, there are only 6 companies, generally referred to on the internet if you were to Google this as the Big Six, that offer an own occupation or own specialty. That's Guardian, MetLife, Standard, Ameritas, Principal, and Mass Mutual. I've had some of my competing people meet with some of my clients and offer a company that's not on the list and claimed it was own occupation or own specialty. That is not the case. So you want to have a company that's from one of these 6 providers if an own occupation or own specialty definition of disability is important to you. Let's go through some features now. So the first thing on a contract is, when does the benefit start? As I talked about, I'm talking about long-term disability plans today. So generally the plans start after 90 days, but you can do 180 day start, 365 day. You can even shorten it up if you want to and go to a 30 day or a 60 day. The shorter the benefit period, or the shorter the waiting period, the more expensive the plan is going to be. There's a significant cost increase to go from a 90-day wait to a 30-day wait. There's also not that big of a cost savings to go from 90 days to 180. So most people that I talk to, if they choose to go with a policy, go with a 90-day waiting period because that's priced best from the insurance company. The next question is, how long do the benefits last? You can get a 5-year benefit, 10-year benefit, age 65, age 67, age 70, and there's 2 companies out of the big 6 that will offer a lifetime benefits, either in form of a lump sum or they'll just pay you for as long as you live. Another question to ask is, what happens to the premiums if I'm on claim? All companies waive the premiums. Some waive them 6 months after recovery. Some you have to be disabled for 6 months for them to be waived, but it's a feature that you want to understand. And the last one, again, verifies again the definition, is what happens if I can still work but not in the same capacity. So let's use the example of a interventional cardiologist, and that is your specialty. What would happen if the company pay if you couldn't do interventional cardiology, but you could do family practice? How would that be treated? Or what if you were a family practice doctor that could no longer practice family medicine, but you could teach it as a professor? So those are the important definitions on what does a company consider a disability. Now here's a few riders we go through. Residual rider. So what a residual rider does is, if I use that example again of an interventional cardiologist, is if the person can still be an interventional cardiologist but they can't do it full time, they're considered residually or partially disabled. So if the interventional cardiologist was making $500,000 a year, was still doing interventional radiology, but maybe was doing it half time or taking some days off or could only do half the procedures, how does that rider work? Every company is different on how they treat a residual claim, so make sure you understand how the claim works. Some companies have a loss of time, so not only, and a loss of duties, and a loss of income. So some companies just have a loss of income clause. So it's very careful that you have to understand how the residual works. The next thing is a cost of living rider. You'll hear this called to as a COLA, cost of living adjustment. This is an inflation benefit protection. So if you went on claim on $5,000 a month of benefit, you wouldn't want that $5,000 a month to be level for the next 30 years of your career. Cost meaning adjust that benefit up either as a fixed rate, or a lot of companies will tie it back to the consumer price index. The next thing is a catastrophic disability benefit rider. What this is if you're catastrophically disabled, the policy will pay out extra depending upon what you put into this rider. So it's very inexpensive rider, and it's very unlikely that you'll become catastrophically disabled. Like, it's not that hard to envision becoming disabled if you can't practice medicine, but it takes a lot more of a disability to get to the point where you can't walk and feed yourself. Another thing is, we talked about briefly before, is a lump sum or lifetime rider. Then there's also a student loan rider. A student loan rider would pay you extra depending upon what your student loans are. So if you had a $1,000 a month student loan, you could put a rider on some policies, not every company has this, that would pay the $1,000 loan for you if you went on claim. And the last one's a future increase. And the questions asked here is, how often can I increase my policy? How much can I increase my policy by? And how long do I have to increase my policy? Exclusions. So a lot of policies are issued with exclusions based upon health issues. So if you go through underwriting and you have, let's say, a bad knee, you're probably going to have a knee exclusion. Or if you've seen a chiropractor in the last year, you're probably going to have a chiropractic exclusion, or something on your back's going to be excluded. Most exclusions aren't permanent. They can be reviewed after a certain time period has passed. So if you get a policy that has an exclusion and you have no issues for 2 years, you can usually get that policy exclusion removed. One thing to pay extra attention to is mental, psychiatric, anxiety, depression disorders. Some companies automatically limit benefits to 2 years on mental nervous claims. This is one of the biggest costs to insurance companies, is to cover mental nervous disorders. So a lot of companies limit it. You want to make sure that if you get a policy, or if you're looking at a policy, to understand how do they treat mental, nervous, stress, anxiety, alcohol abuse, drug abuse. All of those topics fit underneath mental nervous orders. In summary, I would strongly recommend, if you don't have a disability policy, an individual disability policy, get one. When you're getting one, pay special attention to definitions and the mental nervous exclusion. And if you already have a policy, you can use this presentation to go back to reevaluate the policy's definitions and whether or not your mental nervous are covered. Some carriers, this is especially important for females, will offer a unisex rate. This can pretty much be the only deal you get in a disability insurance, because if company A costs more than company B, it's generally because company A has a better policy. The one exception would be, especially for females, is if you can get a unisex rate, and there are a couple carriers that will do that through UW, that can be a fairly good deal. Now lastly, underwriting can be tough. So try not to be offended if you go through underwriting thinking that you're a super healthy individual and the underwriter puts a rating or exclusion on your policy. That's very common and can usually be fixed in the future. If you have any questions on this, my contact information is on the first slide. Feel free to email me or call me, or I can see you at one of the question and answer sessions that we're having scheduled in the future.